Earlier this year, I made a video with 30 stocks that I want to own forever. Not hype stocks, not story stocks, businesses, real companies that make real money, and they've probably been around for a long time with a proven track record. So when someone asks, Paul, if you had to choose just one, that's really tough. In fact, here's the problem. Picking just one stock, that's not how I invest. I'm not a speculator. I don't go all in on one idea. My process is simple. I build a basket of great companies and buy them when their price is below the value I have assigned to them. Some will outperform, some won't. But over time, the goal is that I buy them at the right price so that as the value comes into play and the price meets the value, I'm able to hopefully outperform the market. I'm going to try to narrow that field for the sake of this video because something interesting is happening right now with one specific company. There's a growing company on my list. I believe the business is solid. I believe that the industry has immense fear right now, and the stock has been beaten down dramatically. And when it was beaten down dramatically, guess what happened? It was beaten down again and beaten down again to the point where price and value, in my opinion, are no longer even close to each other. Now, I already own it and I'm adding to it, but I want you guys to remember one thing. The goal of these videos is not to sit there and give you a stock to buy. I never will ever do that. I'm here to teach my process, the process that I use to buy companies, to buy them at the price that makes sense to me. You will disagree with me on many things in this video, but overall, the goal is that you learn the way in which to think, which value investors tend to think the same way. Now, let's start with this. Here is the list of stocks that I revealed back in January. The whole premise of that video was simple. I would love to own these companies forever, but only, and this is very, very, very important, I will only buy them when the price is disconnected from value, when price and value are like this. When they sell at the price I need, I'm going to buy them. Until then, I wait. That list includes companies like Microsoft, Google, Southwest Airlines, Meta, Alibaba, American Express, Berkshire Hathaway, Apple, Visa, MasterCard, and Home Depot. Then you've got Lowe's, McDonald's, Disney, Adobe, Nike, Ferrari, Louis Vuitton, T. Rowe Price, Sherwin-Williams, Generac, and Starbucks. And then rounding it all out, Otis, Intuit, Costco, Target, TJ Maxx, Brookfield Asset Management, Sprouts, Cintas, Johnson & Johnson, Hershey, and Procter & Gamble. It's actually 33 total businesses. Right now, I own 13 of them. But if I'm going to narrow this down to one, right this very second, it always comes back and will never stop coming back to price versus value. More specifically, price relative to value. So, how did I find the value? Well, what I do is I start out by running a full 10-year analysis in our stock analyzer tool. I make assumptions about the future, like price to earnings ratio, free cash flow ratio, profit margin, revenue growth, and I do this with a margin of safety. That margin of safety means if I really truly expect 10%, maybe I put in 8% because I want to have that margin of safety there to make sure that I'm not buying on all the best case scenarios. Guys, this is an art. It is not a science. Yes, we use a lot of numbers. So people think, oh, it's numbers, therefore it's exact. No, you're going to have different assumptions than I am. That is perfectly fine. When I show you my intrinsic value later in this video, you can pause it. You can open up the stock analyzer tool yourself, plug in your own numbers, and see where we agree and where we may differ. But before we go any further, I need to say something very clearly. I do not want you buying a stock because I own it. Even if Warren Buffett owns it, you should not own anything because somebody else owns it. Doesn't mean you don't get ideas from them to do your own research. But the key here is I buy stocks for different reasons than you will. I will buy them for different assumptions and different margin of safety than you will. But the goal here in these videos is always to teach a process of how I think. You need to understand what you're buying at all times. We're here to teach you how to fish. This video is actually part of a much bigger journey. I'm showing you how I think, how I value a business, how I make what I believe are educated assumptions about the future of a company so I can estimate value and patiently wait for the price I need. If you're new here, you're not going to find hype. In fact, you're probably going to hear things you've never heard on YouTube. And this is the reason I teach, because there are too many people online committing what I call financial manslaughter. They hype up stocks, they talk about gibberish that makes no sense, they chase price movement, and they call it investing. Guys, that's not investing. That is speculating. If you think that you're right because the stock goes up in the short run, or you're wrong because the stock goes down in the short run, that isn't investing. Good thing for you is you have found the right channel to watch and change that thinking. So if you're following along and watching all of our videos throughout the month, you'll find that we're analyzing businesses. We're looking for great prices, and we're ignoring the hype that's really just overpriced junk. So as we start to narrow this list down, here are some of the candidates, and the only reason they're candidates is price relative to value. Right now, that group includes Southwest Airlines, Adobe, Nike, Sprouts, Target, and Intuit. Each one of these, based on my assumptions, is selling at a level that at least gets my immediate attention. The market has pulled them back enough to where they're worth digging into deeper. Now, on top of that, we've also been analyzing Meta, Alibaba, American Express, Visa, and a few others from my list during our live streams and in videos both on this channel and our Plus channel. These stocks in particular are starting to sell at prices that are getting interesting. And the best part is, we haven't even had a bear market yet. I believe these stocks will go even further down in a good bear market. And as I said earlier, this video is a journey. You're watching how we filter, how we eliminate, how we compare opportunity to risk. Now, out of all the names I've mentioned, one company stands out to me. It has strong fundamentals, it has real and growing cash flow, and it has growth in the business underlying business. But the stock has been beaten up to a point where people think the business is dying. That company, Adobe. When I look across this narrow field, Adobe has most of my boxes checked. And now let me explain why. Adobe is trading roughly 41% below its 52-week high of 464 that reached in 2025. That's not a small dip. Guys, I want you to also know, just because it's selling cheap relative to the 52-week high or low does not mean it's a buy, but it's a great place to start to take a look. So what happened that caused this big drop? Well, the big driver has been what I call the AI fear trade. Investors looked at generative AI tools like OpenAI Sora and Anthropic's new models and said, uh-oh, professional design tools are about to become extinct. And you've got competition. Canva, Affinity, Figma, which is now independent again after the $20 billion deal fell apart. These lower-cost, browser-based tools look flashy and are accessible, but let's zoom out a little bit. Adobe is still deeply embedded in professional workflows. Enterprises don't rebuild their creative infrastructure overnight. Switching costs are real. That's a moat. And here's the part that I think people ignore. Adobe didn't miss AI. They integrated it. Firefly and their AI tools saw monthly active users jump 35% to over 70 million back in 2025. This isn't a company that's asleep at the wheel. Institutional ownership is still over 81%. Meanwhile, the business generated over $10 billion in operating cash flow in 2025 with gross margins that are almost 90%. Guys, that's a cash engine. What does that gross margin mean? It means every single time they get a sale, almost 90% of it is profit. And when a company with those kind of margins, elite margins, strong cash flow, and the kicker, stock repurchases gets cut almost nearly in half because of fear, that's when I start paying attention. So let's take a look at Adobe here and run it through some numbers and see what we think of it. So I'm pulling it up, guys. By the way, the all-time high in this company was $700 a share. It's at $258 right now. It's a $108 billion market cap. It used to be almost, $300 billion, maybe more. What I love is the free cash flow is way greater than the net income. Everybody out there is focused on net income. Net income's good. Over a long period of time, net income and free cash flow should equate out. But net income is also easy to manipulate, and it's very rare to find 5-year free cash flows greater than net income. We have that here. It's selling for almost single-digit free cash flow. It's selling for 11 times free cash flow for a company that still has growth potential. Our community member is one of the highest-rated communities, has it as a buy. Doesn't mean we're right, but as I tell people, if I can have 30 or 40 companies that have these kind of metrics, I'm going to take a look at them. And when you see later on the stock analyzer what I mean, again, if I have 30 or 40 companies with those kind of fundamentals and valuations, I'm probably going to do well. Now, profit margin. What I love is it's getting better. So this dying business went from 28.6% the last 10 years to 30% last year. Hopefully this continues on. But the good news is, even if they have to sacrifice some profit margin to keep market share, they have it. 30% bottom line, and almost 90% gross margin. They can do that if they need to. Another great thing, look at this revenue growth. Yes, they've made almost $3 billion in net acquisitions in the last 5 years, but that's not a lot for a 12-figure business. Is that right? 9, 10? Yeah, 12-figure business. Revenue growth, 10.5% a year for the last 3 years, 13% for the last 5, 17% for the last 10. I had a friend of mine recently say, well, Paul, the growth is slowing. I'm like, well, no shit, it's slowing. It's a huge company. Again, slowing growth is okay if you pay the right price. The question is, what is the right price? Now, let's go look at its 8 pillars here. 8 Pilla Thrilla. 5-year PE, 5-year price to free cash flow, super cheap. You got high returns on capital, 26% for the last 5 years. Shares outstanding, buying back shares. Cash flow is up $4.5 billion in the last 5 years. Net income's up $1.8 billion. Revenue's up $11 billion, and very little debt. They can pay off all their long-term debt with 1 year of free cash flow. 1 year of their 5-year free cash flow. That's the incredible part. Guys, I'm looking at this going, this is incredible. Now, throwing a lot at you. I get that. It may feel overwhelming. I've been there. Everybody's been there. Even Warren Buffett has been there. But I asked that if you really want to figure out a way to understand what you're buying, which will then lead to less fear as stocks fall, this is the channel for you. Now, I want you to do me a favor. All these metrics are important to understand. But obviously, you need to be able to look at what they mean. Instead of typing on the internet, I made a great cheat sheet for you. Click the link below. We will send you our key metrics PDF. It'll explain all of these metrics, what they are, how they're calculated, what they mean. That way you can have it ready for you whenever you're looking at companies, whether you have our software or don't have our software. And in just a minute, guys, I'm going to use our stock analyzer tool to make assumptions for the future and figure out the price I want to pay for Adobe. So before we get there, let's look at analyst estimates. Now, these are analysts, and they have their bias just like everybody else does. But they have, and I'm sure they're going to modify this, they have $24 per share in profit this year, growing to $34 in November of 2030. Now, I'm sure they're going to adjust these, but I look at this going, doesn't look like a business that's failing that much, a business that's falling. It could very well still do that. But that's the key here. We're here to understand if there's enough margin of safety, even if profit stays the same or declines, you can still make a lot of money. All right, so now we've come to the point where we pull up Stock Analyzer tool. This is the tool we use to sit there and make assumptions about the future, and it'll tell us what price to pay based on those assumptions. I'm doing a 10-year analysis. Of course, you can do anywhere between 1 and 20 years. But let's pull up the last time I did Adobe. Guys, my 10-year analysis, I did 5, 8, and 11% revenue growth. Now, if you recall, free cash flow is higher, which I think is better. So I'm going to focus on free cash flow. I did 37, 40, and 43. Keep in mind, guys, they basically did 40 for the last 5 and 10 years, and last year they did 41.5%. So I think I'm being pretty good right here doing this. Now, what PE, what price to free cash flow do I think this company should have 10 years from now? Well, guys, I always tell people, start at 15 or 16 in your head. That's the market average. You go higher for good companies, lower for bad companies. So what makes a good company? Good growth potential, good moat, high returns on capital. Guys, guess what? I think this company has all three. I think they still have growth potential. A lot of people assume double-digit revenue growth and definitely double-digit profit growth. Increasing returns on capital. These are the things I look at going, this is a premium business, so I'm giving it a premium valuation. I actually went conservative in our last video. I had it as 18, 22, and 26 before. Let's just put in 16, 19, and 22. Then finally, this is where you and I are going to definitely differ, and we should. What's our desired return? Guys, I put in 9 or 10% just to get the market return so I can find out what is this company worth, not what I'm willing to pay for it. You need a margin of safety. But it's a very personal topic, like what margin of safety is right for you. The bottom line is the higher the return, the greater the margin of safety. The lower the return, the lower margin of safety. So I'm just putting this 9% in here just so that you see what I think the company's worth. I have made every possible investing mistake you can imagine. I bought too high, I sold too early, I listened to the wrong people, and that's exactly why I built Everything Money. It was first built purely for me. I wanted the tools that gave me clarity and decreased the fear of investing. People saw me using these tools on YouTube and said, Paul, can you share those? And at first I said, no, it's a data feed. But then I realized I could make this. So I did. And the real community was born. Real people sharing ideas, live chats, live streams, and tools that help you beat 99% of investors, but most importantly, help you sleep better at night because money can be very scary. I still use these tools every single day, like Stock Analyzer, Real Estate Calculator. So stop guessing, start learning, start sleeping better. Try it for $7 for 7 days. I'll see you in there. So I hit the Analyze button. The stock's currently at $258. This is why I'm interested. I have a low price of $275 to $390, a high price of $660 to $886, middle price of $430 to $589. That gives me a discounted cash flow return of between 15 and 27% based on today's price. Guys, what I said earlier was true. I don't know what's going to happen with Adobe. It could very well be a dud. I could very well be wrong on this. But if I have 30 or 40 companies with these kind of potential returns that are all large cap businesses, I'm probably going to do okay. Why? Because not every large company is going to zero. So let me leave you with two really big lessons. Lesson number one, if you took Adobe's current price, added 2 or 3 zeros to it, and you still said, yeah, I'd invest in that, you're not investing anymore. What I mean by that is people always fall in love with the story. And what I always tell them is, great, 258. Make it 2,580. Is your story still true? Well, yeah. Okay, add another one. Is it still true? Yeah, that's not investing. That's the part I'm trying to get at. When you attach yourself to just a story, price no longer matters and you're just speculating. Now, if you include financial metrics in there, obviously, if I add a 0 to this, to 2,580, the PE goes from 11 for price to 110. Very different investment then. That's what I want everybody to remember. I love giving that example because it's really true about things like Bitcoin and art pieces and things like that. But what makes Adobe this wonderful business, but what makes it interesting investment to me is price relative to value. If you add 2 zeros to the stock price, I'm out immediately. In fact, add 1 zero to it, I'm out. It's that simple. Price matters. And here's the funny thing. People want a deal in everything in life. They'll drive across town to save a few dollars at the grocery store. They'll negotiate on a couch. They'll brag to everybody about how they saved $500 on a car. When it comes to investing, suddenly it's the story that matters and that's it. They'll pay anything for a good story. Guys, that's backwards. Okay, lesson number 2. Don't get emotionally attached to a stock price. The stock doesn't know or care that you own it. It doesn't care what you paid and it doesn't know what you paid. If you buy it at 200, it goes to 260. You don't automatically avoid it just because it went up. If the numbers still justify the price, you may want to continue buying. The same thing on the downside, because guess what? You're never going to buy the bottom. If you buy at 200 and it drops, you don't panic just because the price dropped. If your thesis hasn't changed, if the value is still there, the price movement alone means nothing. We are investors. We focus on value. We let price relative to value, not emotion, drive the decision. So if you like this Adobe analysis, I actually picked 6 other stocks alongside Adobe to go head to head with the Magnificent 7. We checked them all through 2025 and now into 2026. I got to tell you guys, it's getting really interesting. The results will probably surprise you. So click on the video on your screen right now to see why I picked them and how they're stacking up. Thank you for your time.